Hello, this is Brian Rezny, President of Rezny Wealth Management and of course host of the Rezny Wealth Report. We have a great show for you today. We're going to talk a lot about investment strategy. We're also going to answer your questions about your portfolio. You can always send an email question to brianrezny@reznywealth.com. You can also visit our website, reznywealth.com, and sign up for instant email alerts as they happen. Market conditions, what should you be doing right now with your money? If you'd like some great information sent directly to your email box, and it is free, go to reznywealth.com right now and sign up for instant email alerts. You know, I want to talk about the current market conditions, the U.S. economy. Of course, we are into the fourth quarter of 2014, and generally speaking, the economy is doing pretty darn good. But what I will tell you is this: investors, unfortunately, don't make great decisions with their portfolios, whether they're do-it-yourself investors or if they're working with a Wall Street firm, a bank, or an insurance agent. The reason why? Most investors who manage their own money do not follow a real investment strategy. They shoot from the hip. People that work with Wall Street firms, the local person at the bank, or maybe somebody who sold you an annuity, those firms really don't manage money either. You're usually working what's called under suitability, and you have a brokerage account. Now, while that person may call and give you some ideas on what mutual fund or stock to buy and sell, they're really just selling. They don't know much more about the market, probably, than the average investor. If you want a real investment firm that actually manages your money, only work with a fee-only registered investment advisor in a money manager capacity. Statistically, that's less than 10% of real money managers in this country are fee-only registered investment advisors. No Wall Street company, no bank, no insurance company is fee-only, and most of them really just sell investments they manufacture and are required to sell versus real money management. But let's talk about strategy and really what goes on in the real world of investing. As an investor, you have to realize that you have to make sure that you have a strategy that you follow. What investment behaviors undermine investment performance? We're going to talk about that today. One of the things that really hurts you, the investor, of course, is not having an investment strategy. Not following a disciplined plan of approach, emotions that will wreak havoc on your portfolio. As an example, a few weeks ago, we had a little turbulence in the market. Did you throw in the towel? Did you get nervous just because maybe one of your investments or your portfolio dropped 2, 3, 4%? That's natural in the course of investing. But investors get nervous, so they make bad choices. Your investment strategy needs to be adaptive in order to adjust to changing investment and market conditions. What does adaptive really mean? It means you don't buy and hold a group of mutual funds, don't let Wall Street sell you an annuity that you just sit on and forget it. That's not adaptive. But adaptive is not trading every single day. Adaptive means you look at the economy, the investment markets, interest rates, unemployment, various factors that drive the investment decisions within your strategy. Simply put, even though stocks can bounce around a little bit as they make new highs, investors think that bonds are safe. But guess what? Bonds can also bounce around and go lower when interest rates go up. So ultimately, adaptive means owning investments or asset categories that are appropriate given the current economic climate we're in today, and adjusting that allocation when things change, like interest rates. I've talked about this for over the last 6 months to a year. Eventually, rates are going to bottom and they're slowly going to move up if the economy continues to do well. If the economy does well and rates continue to move up, investors who put too much money in long-dated and intermediate-term bonds or bond mutual funds have the potential to lose a lot of money, while equities could actually do quite well. Investors spend far more time searching, not researching or following an investment strategy. Let me explain. You show up to the cocktail party, you're at dinner, you run into some friends or neighbors, and everybody's talking about how they just bought Google, or they bought Facebook, or they bought XYZ stock or mutual fund, and so you jump on the bandwagon. Or you hear something on TV. That's not research. That's basically shooting from the hip and buying something you heard about. Actual research on investing takes time and discipline. Developing an investment strategy that drives your decisions, not your emotions. So while most investors who self-manage their money or use a Wall Street firm or bank or insurance company really are not following any discipline or strategy, they're really just being recommended investments those firms recommend and manufacture, or if you're doing it yourself, you're getting tips from the broker when you call either online or in person on tips on what funds or mutual funds to buy. That's not a strategy, and don't expect them to call you when it's time to sell, because again, that's a sales position. So, what's your investment strategy? Have you developed one? And that strategy must include not only when to buy and what to buy, but when you need to sell and reduce so you're adaptive. If the economy falters and slows down, that's usually the time you want to start selling equities when the economy starts to get weak, not when equities are already down 30, 40%. By the way, there's a lot of great indicators you as the investor can look at in order to know when to sell equities and then reposition in maybe gold, bonds, or cash in order to be a safe haven when things get bad. Making a return on your investments boils down to two things: knowing what works and doing what works. So bottom line, that investment strategy, which if you follow should have been back tested. If you follow that strategy, even when it's temporarily not quite working, hopefully it will work over longer periods of time, which most strategies end up working. But if you don't follow your strategy and those set of principles, what's going to happen? You're going to go right back to shooting from the hip, emotions, and your Wall Street broker, who again is not really managing your money. If you want a real investment management firm, find a fee-only registered investment advisory firm like Rezny Wealth Management, who actually manages portfolios, doesn't sell investments, and actually does what they're supposed to do and what you intended your so-called advisor to do all these years, but unfortunately, they're not. Larry in Miami, Florida. What is the difference between mutual funds and CEFs? Great unbiased show, thank you. Larry, a closed-end mutual fund, which is a CEF, that's what that stands for, is a lot different than a mutual fund. Mutual funds are open-ended, meaning many investors can keep adding more and more money to that mutual fund. A closed-end fund issues a set number of shares. That's it. Most closed-end mutual funds also deploy what's called leverage. They borrow money in order to juice up returns or potential returns, and that's the big word, or to juice up dividend or distribution payouts. If you're going to invest in a mutual fund, those are a little easier to understand. Closed-end funds are much more complicated and often riskier than their same kind of mutual fund counterpart. As an example, I talked about leverage. Leverage gets you, the investor, into trouble. I can tell you, I've been managing money for 28 years, and we're getting a lot of calls in the last 2 or 3 years because interest rates are low, CD rates are low, so investors are starved for income. So what they're basically doing is they're going out and they're basically buying closed-end funds that show these big distribution rates of sometimes 8 or 10%, not understanding that distribution is sometimes return of your own money plus dividend or interest. And they're leveraged. So if interest rates fluctuate or the market, you could lose a lot more money on the downside, and often these things don't really make much more money on the upside. Most investors should avoid closed-end mutual funds, in my opinion, and I would rather have you look at something like an ETF or an exchange-traded fund, which is cheaper, easier to understand, and far less risky for a similar asset category. Eric from Naples, Florida. Are bank loan funds a suitable money market replacement? Absolutely not, Eric. These kind of funds, these floating rate bank funds, which I think are appropriate in this low interest rate environment, are definitely not a replacement for a money market. A money market account is safe money. Granted, you're not going to make any money, maybe 0.25% if you're lucky in most money markets today, but it's not a replacement, a bank loan type fund, because they will have a little bit of volatility. So if you want safe money, as an example, that you're going to save for the next house purchase or a college payment, put it in a money market. You're not going to make much, but you won't lose anything. If you're trying to diversify your portfolio for income and a little bit more stabilization, then a bank loan fund today as a replacement for some of your mutual funds that own bonds or individual bonds would make sense, because bank loan funds are very short-term maturity and they're not impacted the way typical bond or bond mutual funds are when interest rates go up. So again, if you have a floating rate fund, those are typically short-term duration, real short-term, about 90 days, where a lot of mutual fund bond funds or bonds might be 5, 10, 15-year maturities, much more risky. When rates go up, you can lose a lot more value. So bank loan funds are appropriate for part of your fixed income portfolio, especially in today's environment. Tom in Cape Coral, Florida. What is the role of bonds in a portfolio? Do you believe in the weight of bonds based upon age? I am 65. Tom, I do not believe that an investor who is 65 years old should have 65% of his money in bonds. Nor do I believe somebody who's 80 should have 80% of their money in bonds. And at the end of the day, Wall Street likes to push these kind of mathematical formulas that everybody should kind of be put in a corner. Let me explain. If you're 65 years old today and you put 65% of your money in bonds, and you and your wife, by the way, combination, have a life expectancy between 25 and 30 years, one of you will live into your 90s. That's a long time. If you put 65% of your money in bonds that are currently paying the lowest rates in history, around 2 to 3%, well, inflation's running about 3%. You're not going to make any money on 65% of your money. The next 25 or 30 years makes 0 sense. Look for what's called total return. Sometimes you want a little bit of fluctuation in that portfolio where you can get a dividend, potential growth, and as long as you don't need all your money in the next 3 years, which you should not, Tom, at age 65, you need it over the next 30, you need income and growth to combat inflation, you want to reduce your allocation of bonds. Typically, what I like to look at is bonds. If you're a more conservative investor, use more short-term duration, 3 years or less today, or floating rate type securities, as I talked earlier. Maybe hold 20 to 30% of your portfolio, something where it's between 3 and 5 years living expense that's pretty safe and less fluctuation, good interest, but less fluctuation. The other money's in assets that can grow and get total return. And any time within that 1, 2, 3, or 4 year time frame, you can sell some of your growth and replace the money you've drawn down on those more conservative investments. It's a smarter way to manage your money. You'll still have a good conservative portfolio, but the chance for a much better return, in my opinion, is there versus listening to Wall Street and sticking too much money in bonds. Terry in Boca Raton, Florida. What do you think of all the negative bubble headlines you hear every day? And what should an investor do? Terry, I've been managing money for 28 years. I can tell you I've heard pretty much every negative headline there is, whether it was a terrorist attack, whether it's this Ebola scare that is now out there, whether it's Russia and Crimea or ISIS. There's always something going on. What I would suggest you do, remember this, most of these news services like to sell the hype, the negativity. Investors buy into negativity. They like to listen to things that are negative versus positive. So this is what I would do. At my firm, we don't listen to any of this negativity, nor does it's not used in our decision-making ability when we manage client accounts. We look at the hard data, the fundamentals, the financials, in order to make appropriate decisions how we're going to arrange our portfolios for our clients over the longer term. There's always going to be something going on in the news. If you are managing your portfolio based upon the news and all this kind of craziness you hear, you're going to make big mistakes. I'll give you a great example. We received a couple, 2 or 3 phone calls from some of my radio listeners not too long ago that basically sent us email questions followed up by a call into our office, and essentially they were scared to death because of that short-term volatility you've seen in the last couple weeks. They wanted to know from us, what were we doing with our clients? Were we liquidating portfolios? What did Brian think, because we hear him on the TV and the radio all the time? And basically what we tell them is this: if you're an investor and you're worried about a 2 or 3% fluctuation and you threw in the towel, and then a couple weeks later things pop back 3%, when do you get back in? This emotional investing, the news is noise. Ignore it, do not trade off it, do not invest off it, or you will be making the biggest mistake you possibly can. Your returns will be hurt, you'll take more risk, because what's going to happen is you're going to end up selling low and buying high, and you'll repeat that 2 or 3 times in the next 3 years, and guess what? You would have made no money when other assets might have been up 20, 30, or 40%. So don't make emotional decisions. Turn off the noise or the news that's emotional and do not let it affect your portfolio. What I'd also suggest is hire a real investment firm like Rezny Wealth Management, we'll take that emotion out of the equation so you have a better chance of meeting your long-term retirement and investment goals. I have to go to a quick break. I'll be right back with more questions after this. Hello, this is Brian Rezny. If your goals are to increase your retirement income and retire without stress, go to my website and download our groundbreaking free report. This free report covers the investment and retirement pitfalls that are often overlooked even by the smartest investor. If you're concerned about outliving your money during retirement, or maybe you want to make sure you're not leaving money on the table, this free report is for you. Know the facts. Your retirement depends on it. Go to my website, reznywealth.com, and download your free report right now. Hello, and we're back. I'm Brian Rezny, president of Rezny Wealth Management. I hope you've been tuning in on our whole show today. We've got more questions we're going to answer. I'm going to talk more about the economy, the markets, and more importantly, what you should be doing with your money so your money is not taken advantage of by Wall Street, banks, and insurance agents who want to sell you inferior, expensive investments. Also, I would encourage you, visit our website, reznywealth.com. If you go to my website, you can sign up for free access instant email alerts that show up in your email box as important investment and financial things happen that we put out independent research. Go to my website now, sign up for free. You can also download any of our free reports. Reports like your #1 investment risk and how to avoid it. This is the biggest risk I see investors are taken advantage of all the time. If you can avoid this one major risk, we firmly believe as a firm you can prosper, you can make better returns, you can cut your expenses, and you can live a much more safe and secure retirement. Go to download that free report right now at reznywealth.com. Todd in Naples, Florida. Are you concerned about equity valuations? Todd, I'm not concerned about equity valuations currently. Now, a year from now, 10 years from now, I may be concerned. What I will tell you is this: if I look at equity valuations, let's say the stock market, the S&P 500, which is what most people generally kind of benchmark valuations on, if I look at this year's numbers, the S&P right now is trading at about a 17 PE ratio. Based upon 2015 numbers, we're going to trade about a 15 PE ratio based upon the expansion of earnings. That is pretty average and pretty reasonable. So what we're seeing is corporations are growing revenue, which grows earnings, and if that continues to happen, typically equity prices will follow with little bumps in the road. What you might be concerned about is the stock market, because it's at a new high, is it too expensive? No. If I look at 2000, remember the year 2000? Back then, the S&P was trading at about a 35 PE ratio. Right now, it's about 17, so half of that. If I look at the NASDAQ back in 2000, it was trading about 80 on a PE ratio. Right now, it's trading at around 16. So again, at the end of the day, valuation does matter. So the markets are not overheated. Now there's certain sectors that might be a little overheated that I think are expensive, like Europe. I would avoid Europe at all costs. I think the emerging markets have some great value there and very low valuations. I think the U.S. market, generally speaking, is very reasonably valued. Some areas are cheaper than others, so you want to pick your spots. And also, it's relatively strong and what's also relatively value-oriented in addition to relative strength, which can give you a chance for outperformance. So the markets look good to us. They're not overvalued. They're not undervalued. And as long as earnings grow and revenues, remember, earnings drive valuation or the potential of. We like what we see, and I firmly believe this could be an extended bull market that can last many more years as long as the U.S. and the world economies continue to expand. Mark in Sanibel, Florida. Gabelli Utility GAUCX pays a huge dividend. What do you think of that fund? Not a big fan of that fund. If it's a utility fund, generally speaking. So if you wanted utilities, I would rather have you look at an ETF or an exchange-traded fund. I would look at the XLU. It basically buys a basket of utilities, similar principle to that Gabelli fund that you are asking the question on. The difference is the Gabelli fund has a much higher internal expense ratio. XLU is dirt cheap, and I think it'll provide you better diversification and better potential. So with that, look at something that gives you better opportunity, which is the XLU. But I'm going to tell you this. My last question was about market valuation. If I look at utility stocks almost across the board, that's one area that I would really be avoiding on a fundamental and valuation basis. While utilities have done pretty well this year because investors keep flocking in trying to get income, it's pushed those values sky high. Utilities typically trade at about a 20 to 40% discount to what they're currently trading at. So if you believe in overpaying for something by 20 to 40% just to get a little bit more income, knock your socks off. We currently do not own utilities, and we do not plan on buying any utilities in the near future. Now, if there was a big correction in utilities like the XLU and it dropped 20, 30%, I might want to look at some bargains then. But utilities are grossly overvalued, kind of like long-term bonds are overvalued because, again, people are stretching for yield, and they've pushed the valuations up on those areas way too high. I'd rather look for total return, maybe something in the large cap like the S&P 500 where you get a dividend, potential growth, total return could be much better in the next 3 to 5 years on large cap with dividends versus the XLU or that Gabelli fund. Sal in Naples, Florida. How can I generate income in a low yield world? I'm sitting on a lot of bonds paying 3% and cash doing nothing. Sal, your question probably comes in a dozen or 2 dozen times every time I do a show, the similar kind of question. Investors are starved, again, for yield, so they're stretching in areas they shouldn't be stretching, and ultimately I think it's going to come back and bite them, in meaning more risk and maybe big downside in part of that portfolio. So what you want to do is, like my last question, look for total return. Think about this. If you can get a 2% dividend and you had, let's say, a 4 or 5% growth on average over the next 3 or 4 years, well, that's, let's say, a 6 or 7% return. Could you sell some of that growth off each year to supplement that 2% dividend and give yourself a higher income stream or potential? You sure can. So remember, income doesn't have to just come from a bond. It can come from an equity or an ETF that pays a dividend, has growth potential that can give you what's called total return and give you a higher income stream potential with some future growth. So next year when you need more income because of inflation, you can take a little bit more off. Too many investors rely just on income investments. They forget growth, which in turn can be turned into more additional income. Sam in Fort Myers, Florida. Can strong corporate earnings spark a renewed rally in stocks? Sam, that's a great question. Yes, it can. Remember, equities, stocks, are driven by earnings. Not in the short term, but usually over the rolling 3, 6, 9 months and 12-month periods. So let me explain. If corporate earnings continue to rise, which they have been this year, and they're projected to next year and in the future, that should equate to equity prices having a chance to go higher. If, on the other hand, we start to slow the economy and earnings start to peak and roll over, that usually spells recession and exiting out of equities or reducing equity exposure. Right now, we're in an expansion mode in the U.S. Earnings are growing, revenues are growing. That gives the chance for the equity markets to go higher. But remember, you're always going to get little bumps in the road throughout the year. I'll give you an example. Almost every single year, the stock market has a 10% correction. Doesn't mean you didn't make money. As an example, go back to 2013. The equity markets dropped about 8 to 10% at one point mid-year, rebounded, and the market ended up almost 30% higher by year end. That's a big jump. This year, we're kind of bumping around a little bit. That doesn't mean we're not going to make more money by the end of the year. It doesn't mean that we might not be down another 2%. But as long as you don't care about what happens the next 3 to 6 months, which you should not, because otherwise you're not a good investor and you're an emotional investor, I think these earnings and revenues we're seeing from corporations are going to spark a renewed rally over the next 1, 3, and 5 years in the general equity markets. Paul in Plantation, Florida. I was pitched an Allianz hybrid annuity for income for life for my 401k plan rollover. What should I be leery of? Paul, you should be leery of everything. First off, let's talk about annuities. Not just Allianz, but all annuities, whether it's these equity index annuities or variable annuities. First off, anybody who sells an annuity for a commission is working under suitability. Under suitability, Paul, that salesperson, he's not an advisor, by the way, he's using a fancy title, is really just a salesman of investment products that his firm represents or manufactures. His interest is to the insurance company or his brokerage firm. He does not legally work for you, and he does not have to give you the best advice. That's number one. Number two, annuities are expensive, they rob your returns, and you insanely lock your money up for periods that can last 10, 15, or 20 years in time with huge surrender penalties to get all of your own money. You never want to do that. Annuities are dangerous to your wealth and retirement, in our opinion. What I would suggest you do is go to my website for free. You can download our #1 report, Why Annuities Are Dangerous to Your Wealth and Your Retirement. By the way, the income for life that salesman's trying to pitch you on, if you're 65 and you do the math, it's going to take you almost 20 years to get your own money back. Not a return on your money, but a return of your own money. Why would you invest in something that's going to take 20 years to get your own money back? Again, do the math. Not to mention you have no inflation protection because it's the same amount of money each year, every year, for 20 years. Don't be sold an annuity by an annuity salesperson whose interests are far different than yours. I know he might have a great personality. He might remind you of one of your kids. He might have bought you a free steak dinner, but steak's expensive, and the heartburn of you getting sold an annuity is going to be detrimental to your retirement for the rest of your life. Don't buy it. Folks, I'm getting close to out of time. Of course, if you'd like to send me an email question that I can read and answer on my next show, send it to Brian Rezny at ReznyWealth.com. Also, visit my website. We've got great information on there. You can sign up for instant email alerts from myself and my staff as things happen. If you're concerned about the economy, if you don't know how to read the stock market, you don't understand really what's going on, but you want great information that's simple and easy to understand, go to my website right now, ReznyWealth.com. You just type in your email, it's free, and you get instant email alerts into your email box. Also, download any of our free reports so you can learn more about what you should be doing right now with your money and how you can avoid Wall Street's confusion and bad investment advice. Folks, I'm out of time. Call my firm for a consultation. We have offices throughout Florida. If you want a real money manager who works at your legal best interest as a fee-only fiduciary, there is a difference. We invite you to experience it. Have a safe and a profitable day. We'll see you next week.